Good afternoon. Myself, Dr. Yogesh Patinge, Assistant Professor, GS College of Commerce, Varda. This is the second lecture of Financial Accounting first semester. In previous lecture, we discussed about syllabus, question paper pattern, and all those details which are required for university pattern. Now from today, we are actually going to start the actual syllabus of Financial Accounting. As I told you earlier, we have to start unit first with theoretical concepts. Now, what are the theoretical concepts? The theoretical concepts are being classified in two parts. One is accounting concepts and accounting conceptions. Those were noted on this whiteboard. And the second part that we will resume in a third lecture of financial accounting, those will be accounting standard. Accounting standard 1 to accounting standard 10, AS1 to AS10. So today we are going to discuss the first point, that is accounting concepts. Accounting concepts, there are total 9 accounting concepts that I had noted here. Why these accounting concepts are important? Because when we are going to start a new subject, that subject should have a base, a fundamentals, a concrete fundamental. On that particular base, that subject stands. If the theoretical approach of that particular subject is not correct, is not good, then whatever you are going to do in that particular subject, it is not going to be feasible, it will not stand. So this is your first paper of financial accounting. In entire 3 years you have to study 5 financial accounting papers. So this is a base. Okay, some part of this particular syllabus is already been completed in your junior college, 11th or 12th, particularly this some part and some part of sole traders. But again, this is a higher level. We have to study a higher level of knowledge. So that's why we have to again touch these topics, and then we will have to move forward for our syllabus. So when we start accounting concepts, the first one is business entity concept. As I wrote here, a small description of that, separate and distinct. Why it is called as separate and distinct means when someone wants to start his business, his identity and his business identity, or her identity or her business identity, is completely different. The liabilities is being different. Whatever the what we can say, the recordings of assets, it is completely different. Responsibilities are different. So that business is a separate individual, it has a separate existence. That person has a separate existence. So when we treat a business, then we have to treat a business as a separate entity, a distinct entity. Why it is called as a distinct? Because you can't compare what is that person is doing in his personal life and what he is doing in a business life. That is completely different thing. Because a business is a separate entity, a distinct entity. You just can't compare that business with that person. So that is the first accounting concept, and it is very important one, because you just can't merge the life of that particular person with a business one. That is a separate thing. Moving to the second concept, that is a money measurement concept. Business to be expressed in numbers. Actually it's a very simple concept, because whatever you are doing in a commerce or in accounting, you have to measure in terms of money. Whatever you are doing, in Indian rupees or in dollars or in euros, anything, but it should be measured in terms of numbers. Just can't write paragraph style or in a style in which that you can't measure, or you cannot do the calculations, or if you can't do the comparison, then doing that financial accounting is not of any use. So the second concept is money measurement concept. It means that you have to be able to measure everything in terms of numbers, in terms of money, whatever currency you have to do. It is not it is not depend on a particular accounting style or whatever accounting pattern following in whatever country. It depends on a currency, and in a currency in which you are doing accounting, you have to maintain that uniformity in the currency. That's why it is called as a money measurement concept. It means that business is to be expressed in numbers. The third one is a going concern concept. It's a long time existence. Means when you are going to start a business, it is assumed that business is going to be run or going to be in existence for a long time. Okay, that is the assumption. But we have to assume. Why we have to assume? Because that when we plan a business, The person who is planning a business has something in his mind that this business is going to be there even after his life, for his what we can say family, for his friends, for his partners. That is called as a going concern concept. Means actually it is quite much related to business entity concept. So when we talk in a business entity concept, that is actually it is a separate entity. This way we can consider here that it's a long time, it has a long time existence. So whatever planning is there, that planning should be for a long time, for a long duration, and it should have a long time existence. If we can say that, for example, a promoter's life is just having an average life of 75 or 80 years, you cannot say for that particular business, because business is going to be run even after the life of that particular promoter. So this is the third concept, going concern concept. It means that business has a long time existence. Moving to the fourth one is a dual aspect concept, give and receive. Give and receive, debit and credit. There should be a dual effect in that. Means you just can't go in a one way direction. You have to move in a two-way direction mode. There should be a giving, there should be receiving. That's why then after you can prepare accounting properly. Otherwise, there will be just a givings and no, if there is no any receiving, then it can be a problematic thing. So there should be a give and receive concepts. That thing is called as a dual aspect concept. It should be the dual recording concept. What we can say, when person is giving something, he should receive something, then after you can maintain their account properly. So that thing is called a dual aspect concept. The next one is the accounting period concept. As we know that there is an accounting year, financial year. It starts from 1st April and ends at the 31st March. Government is planning to change that particular financial year. It's okay. That is another part. That is another thing. What we are discussing here, that accounting period concept, it is to be segmented in periods. It means that if you are making, if you are preparing your accounts, if you are just doing what we can say, preparing accounts, doing audit of that particular account, it should be segmented in different periods. It can be quarterly assessment, it can be a 6 monthly assessment, it can be yearly assessment. What we are doing here, we are actually segmenting that accounting period as per our pattern, as per our system, as per our way of doing the work. So that thing is called as accounting period concept. Why accounting period concept exists? Because if you want to calculate in terms of money, for example, we are correlating this thing with accounting concept number 2. So when we are saying that we are actually measuring the values in terms of rupees, if we consider that we are in India, we are doing accounting in India and we are actually calculating the values in terms of rupees, then when you are actually calculating the values in terms of rupees, the same things applies here, that there should be a particular period, a particular duration to that particular accounting. It can be year, generally it is a year, a financial year, which starts from 1st April ends at 31st March. So, and actually it is a very good thing for doing the comparison also. Means someone just wants to compare this year profits with previous year profit, this year losses with previous losses. For doing this type of comparisons, what is the uniformity needed for that? The uniformity needed for that is the accounting period. So accounting period should have a uniformity. The logic behind that is the same thing, that you have to compare. So the number 5th one is the accounting period concept, that is to be segmented in periods, and that should be a uniform segmentation. Moving to the next concept is a historical cost concept. It is a recorded historical price. The asset purchased, for example, for rupees 100. Now the market value of that asset is rupees 150. You just can't reflect the market value of that asset in your accounting records, because there can be depreciation, there can be the increase in value. But whatever you are doing, you have to record the cost in a historical way. Means the first purchase price of that asset has to be recorded in accounting records in your financial accounts. Whatever there is wherever there is an increase or a decrease, there can be decrease because of depreciation, there can be an increase because of what we can say, the increase in the market price. That is not going to be reflected, because we have to record that cost in a historical manner. The price that has been at the time of purchase, that can be a historical cost price for us. So when we are actually doing a financial accounting, what should we have to keep in mind? We have to keep in mind that price should be recorded at historical price level. Whatever changes is happening after that, maybe in terms of depreciation, maybe in terms of increase in market price, that is not going to be reflected in a price of that particular asset. This is concept number 6. Now concept number 7 is called as a matching concept. The name already suggests us, clarifies us that this concept is going to match. What it is going to match? It is going to match cost and revenue. There should be an equal comparison between cost, equal comparison between revenue, or equal comparison between cost and revenue. That's why, because why it is needed, because it is actually a dual aspect concept, give and receive. So what you are paying, you are receiving. What you are receiving, you are paying. Then that should get matched. That is why that is called as a matching concept. We generally match the things with debit and credit. The figures of debit side and credit side should match. That is the logic behind that. After that we find out the difference and then we find out the loss and profit. That's another thing. But before, what we are doing, we are matching the things. That thing is called as a concept of matching. Cost and revenue should have an equal comparison. Why there should be an equal comparison? Look, the basic motto behind this accounting concept is that when you are building an accounting strategy, when you are building or preparing an accounting pattern, the accounting concepts actually play a role of fundamentals. It is actually a platform on which your accounting completely depends, completely rests upon. So the accounting concept should be clear, crystal clear, should be such a concrete that accounting shouldn't get wronged. So these concepts are actually very important when we are doing financial accounting. Moving to the next one, it is a realization concept. Why it is called as a realization concept? Because when there is a sale, there is a realization of price. Means if you are buying something, after buying something, or if you are acquiring something, but when you are selling that particular product, that transaction get completed. So that's why I noted here, sale is a complete. When sale is complete, the transaction get completed. So sale is actually a closure of that particular transaction, and that transaction should get closed. When a transaction will get closed, then only that concept will be fulfilled, and then only it is called as a realization concept. Otherwise, if your transaction is not get locked, how you are going to record that transaction in financial accounting? Because financial accounting, you are doing what you are doing in financial accounting? You are doing in financial accounting, actually you are closing that particular transactions. The transactions which are open are not the part of your financial accounting, because you are doing those things at the end of financial year. And when you are doing those things at the end of the financial year, it means that your transactions are being closed, completed, effects are being covered, and now you are ready to include those transactions in financial accounting or your final accounting. So that thing is also important. When your sale is complete, then only record those things. That is called as a realization concept. Moving to the last one is objective evidence concept. Why we wrote here? Because what you are doing in financial accounting should be supported by evidences. Even in the accounting convention, the same things applied here. That is called as a to provide a complete information. That we will cover in just within some minutes. Why some minutes? So you have to provide the evidences. Why you have to provide the evidences? Because if you are recording some transactions in that particular financial account, that transaction should be supported by evidence. There should be vouchers, there should be the entries of that particular bills, payment bills, receipts. All those have the entries in ledgers and cash books. And so when you are actually writing something in your financial account or that final account statements, it should have to be supported by your ledgers and cash book. So if some auditor wants to check the things, he should get that records, he should get that vouchers, he should get that evidences. So whatever you are writing here, it should be supported by evidences. And that objective evidences should be shared. You just keeping those evidences in locker and just asking the auditors to just check the balance sheet and say and just give the remark, it is not possible. He will ask evidences, he will ask the vouchers, and then only he will scrutinize the financial accounting records, financial statements, and then only he will say something on that particular financial statement, the way of keeping those financial statements. So objective evidence concept is also very important thing. So these are all accounting concepts which have their own importance, own way of working. So when we are discussing that financial accounting has to do a lot in our life, a lot in our what we can space of marketing, in our real market life, these accounting concepts are actually the fundamentals, a platform of doing financial accounting. So I hope you just have that a small knowledge, just got a small knowledge of these accounting concepts, because we just have to touch a theoretical approach. We just don't have to go in a detailed one. Just we are touching the things because we have to move fast forward for the numericals. Now moving to the last part of this today's lecture is accounting conventions. How the accounting should be properly planned, properly prepared, properly framed, and what should be the behind support of that accounting. The first support is a consistency. There should not be frequent changes for keeping financial accounts or preparing financial statements. If I am saying that if there shouldn't be no changes, it means that the policies shouldn't change, accounting period shouldn't change, way of preparing accounting shouldn't change, a way of what we can say keeping evidences shouldn't change. All those things, if we are going to change in that particular financial year, then we can say that there is no consistency. And if there is no consistency, it means that your financial statements can lack something, can have the problems, and auditor will point out those things that your financial statements, those or your keeping financial statements, preparing financial statements haven't that consistency. So whatever you are doing, how you are doing, it should be consistent. You have to be uniform. Should have a uniform duration. You should have a consistent level of preparing financial statement. You should have a proper way of keeping evidences. You should have a proper way of writing cash books and ledgers. It should be properly backed up with accounting concepts. So all those things are very important when we are actually doing with accounting conventions. That thing is called as consistency. Moving to the next thing is a disclosure. So when we note down their disclosure, it means that you have to provide a complete information. So what is the complete information? Why there is a need of complete information? Because this is actually a public document. You just can't keep your accounting statements in a locker and just convey your message to the shareholders or a SEBI or a market that we have prepared a financial statement. This is our loss, this is our profit, and just whatever like that. When we are talking about disclosure, it means that you have to provide complete information about what you are doing, what you did, and what you are going to do in future. That thing is called as a complete information. Why we have to give a complete information? Because shareholders are a part of your business, and shareholders have a complete right that they should get each and every information, crystal clear information about accounting, about what we can say the profit, loss, and all those operating costs, operating expenses, everything, working capital requirements. That complete information should be provided to the shareholders, to the part of the business. The last one is conservatism, means to play the safe. We know that business is actually a very risky affair. So when we say that the business is a risky affair, it means that you have to play safe game. You have to be very conservative. You have to be very traditional. You have to keep in mind what are the future threats. And when you are actually discussing those things with your board of management, within the board of management, then the approach should be a conservatism approach. It should be a conservative approach. It means that you have to play a safe game while preparing or planning your business endeavor or business projects. So these are the accounting conventions. So today we talked about two parts. One is accounting concept, another is accounting conventions. I hope you understand these parts very well. In next lecture, we will talk about accounting standard AS1 to S10. That will be the last lecture of a theoretical approach, and immediate after that we will start accounts of sole traders. Till then, thank you.